I'm going to focus on facts today. I'm full of opinions, and in the Q&A, I'm sure a lot of those will come out. But in the presentation, I'm going to pretty quickly go through just basic facts about our company. I'm not going to go through all those facts, but some of the things I say may not turn out to be true. I think that's what that says. So Liberty Energy, we started this 13 years ago, right here in Denver, Colorado. We began in the Bakken Shale. And it was partners of mine in other energy companies just passionate to try to make a differential company. And today we've risen, we frack about 20% of all the wells drilled in the United States and Canada, from northeast British Columbia down to the Mexican border. So basically across all the major shale basins, we've continued to sort of stay focused on things we're good at, but broaden the shoulders of our frac business a little bit by adding those extra services that are key to success in frac. I'll talk a little bit about Liberty Power Innovations, which is a next generation frac technology, but we particularly developed it thinking it ultimately would go beyond frac into our electricity grid, because we just keep seeming to doing everything wrong with electricity. Bad for the country, but business opportunity for Liberty. Real quick, for 30 plus years, I and my partners have been entrepreneurs in the energy space, almost entirely in the private world. Liberty Energy is the sole exception to that. We're 6.5 plus years as a public company now. But if you're a private entrepreneur, and I was super naive, just bootstrap capital from people you meet, right, in small amounts of money, and you've got to have strong returns on that invested capital, because the only way to grow a business in that gear is to generate positive returns on your invested capital and reinvest that capital. That's the only gear I know. And so this is, and I'm also very critical of cherry picking data. This is the entire history of Liberty Energies as a company, from when we started commercial revenues in January 2012 to today. So this is cash return on capital invested, just a simple metric. Like, does this business work? And as you can see, our industry is cyclical. Look at this 13 years in business, the two worst downturns in my entire career, the OPEC fought shale and shale 1, and then the COVID downturn. So both of these are volatile, but if you look over that whole period, our average cash return on cash invested has been 24%. 50% above the S&P 500, and nearly triple the OSX over that time period, because that's a tough time period for oil and gas. So I think the business of Liberty works, and we have fun doing it. And maybe, I should have gone back here. Two things that I also think is key, right? You have to have a business that works, that people want to use you as a supplier, and people want to sell stuff to you. You build long-term partnerships and live by your word, good things can happen. But in our industry, since it's so volatile, balance sheet, and I'm hearing everyone that talks today, balance sheets is critical because there's going to be bad times. We view bad times as opportunities. They're going to happen. And so in these two horrible downturns, we made two transformative acquisitions in our company where we bought assets on pennies or nickels on the dollar. So Sandgel in 2016, early on in our history, and Schlumberger's frac business in the depth of the COVID downturn. Both of those very helpful to our story, both for the cost at which we got assets, but also a number of fantastic humans joining our family. Now, to deliver good returns, you got to have great partners, great suppliers, great technology. All of that comes from people and culture. And then, this is not my opinion. This is a great firm, Kimberlite, does an extensive survey every year of all different sectors in our industry, but they call everyone else up. They call everyone up who buys frac services and say, who do you use and what do you think about them? What do you think about these guys? And they ask an extensive question. Thank everyone for their patience to go through this survey, and then they report those results. These are sort of 6 big quality categories. How good are the people, or the technology, or their efficiency, or their delivery? And then these lines, 4 lines, are the 4 major frac companies. Over 60%, maybe close to 2/3 of the wells today are fracked by 4 frac companies. And so 6 categories, 8 years of survey data. This is the entire history of Kimberlite doing the survey data. And Liberty is ranked #1 in every category every year. And that really is a hats off to the team at Liberty. It's just a passionate crew of people. That this isn't a job, this is a mission. This is a mission. We love what we do. We're honored to live in this country. We're honored to work in this industry and our partners, of course, with most of the E&P companies that are in this room. So we're honored to do that. And we have a lot of room for improvement, a lot of ways to get better. But what the scorecard tells me is we're not completely striking out. We got to double down and keep trying to get better. The transformation through these downturns of size, I remember that 15, 16 downturn. I think that's when I first started to get a lot of gray hair. That one was brutal. We entered that downturn with 600 employees. I turned around to our facilities and said, no one is going to lose their job. Your job is to kick ass every day so we can be better at service than every other player. So everything you do is helping the people sitting to your right and sitting to your left. We entered that downturn with 600 employees. We exited that downturn with 600 employees. And we went from 5% market share. We fracked 5% of the wells in the Rockies at the entrance, 25% of the wells at the Rockies at the exit. And then we went down to the Permian, just at the bottom of that downturn. But I remember being proud. We had an average sort of annual EBITDA in that sort of brief mid-cycle period, maybe a little less than $400 million. Probably about $200 million of capital paid into the business. So I thought we're doing well. Then we hit the COVID downturn. And from there, we made a transformative acquisition with Schlumberger. But we went into some additional business lines. We reacquired a proppant handling business that we had actually founded called PropX. And so we diversified our business, built on technology, and grew our EBITDA, our earnings power. Same thing with earnings as well as EBITDA. We grew our earnings, in this sort of mid-cycle to maybe a little over $1 billion a year, almost tripling of our EBITDA. Now, part of that's from an acquisition, but our share count today is about 30% higher than it was. So we tripled the EBITDA and I think the earnings with not a tripling of the share count, but with only about a 30% increase in the share count. Look at a shorter time period and a rougher time period, including 20 and 21, the year of COVID. And of course, 21 in the service side of the business was brutal as well. Commodity prices were rebounding, but activity levels were still low. Pricing was crushed. This is a rougher time period. And if I look at the big 3 service companies in that 4-year time period, they're at now, instead of cash return on capital employed, I'm using that other metric, return on capital employed, where you add in depreciation in the numerator and the denominator. So it's a similar metric with similar results, but using ROCE instead of CROCE. The big 3 service companies over that 4-year period, 0 average return on capital employed. It's a rough time in the industry. It was a downturn. The other frac companies, as a group, 0 return on capital employed. And the drillers, and I only put the drillers in there. I love the drillers. Look, I'm in the E&P business as well. I love the drilling companies, but they're often viewed as less cyclical than the frac companies. They deserve a higher valuation because they're less cyclical. That's just simply not true. And so I show that data here. If you look at the public drilling companies in that 4-year period, they had a -6 return on capital employed. I'm not beating them up. That's a brutal time period I'm looking at. And in that same 4-year time period, Liberty's actual return on capital employed was 11%. And part of the reason for that is here. Even as we came out, 22, of course, was a great year. 2021 were tough. 22 was a great year. And then the industry started to soften, not because activity declined, just because it didn't grow anymore, and we kept getting more efficient. We're getting more done with every rig, more done with every frac fleet. That's progress. That's what we work for every day, and we should cheer for. But the frac fleet count from 22 to the first half of this year is down about 15%. Liberty's frac fleet count is flat. We just have continued to grow market share in our business, not as a goal, But just as if people like us and partners have us and we keep all our crews busy, we're good with that. And we have completed from 22 to the first annualizing the first half of this year, 27% more horizontal lateral feet in the first half of this year than we did in 22. So this is, again, just all part of that Liberty passion to try to be differential. I could go on forever about this, but one of the big transitions in our industry, frac industry and our customers, E&P and the drilling side as well, is, hey, one of the prime movers in the world through the last century, and it will be in the next century as well, is diesel engines. High energy density, easy to work in all different environments all around the world, but natural gas as a fuel is just dramatically cheaper than diesel. The raw material, gas is cheaper than oil, less processing. To turn oil into diesel takes a lot of processing. To turn natural gas and kick out a few liquids and make it less processing. So it's a much cheaper fuel. It burns cleaner too, meaning lower pollutant emissions, and it has lower greenhouse gas emissions. So there's a lot of desire to burn natural gas. The problem is it's hard to move. It's a gas. You can't load it in the back of a truck as easily. So we have not only been building fleets since our second frac fleet in the history of our company was a dual fuel burning frac fleet. No one wanted to burn gas then, and we twisted arms and did whatever we could to try to get people to adopt that. Today, everyone wants to burn natural gas. We've also built a sister business to basically be the virtual pipeline for this natural gas, to tap pipelines or outside of gas processing plants, or even on-site gas, process it and deliver it to our frac equipment. So we can run the frac fleets on natural gas. Saves our customers money, longer lived engines for ourselves, greater profitability, everyone wins. There's another opinion, but not my or Liberty's opinion. Here's a Rystad look at the frac market. Red is demand and black is supply. So think of the peak of supply maybe 6 or 7 years ago. We've had less investment and equipment wears out. So frac equipment supply has been declining. We had a very loose market, therefore weak pricing in 20 and 21. And then as demand goes up closer to available supply, pricing tightens. From last year to this year, we've seen a drop in demand for fleets. That's an efficiency thing, again, to be celebrated, but it makes the market weaker because the available frac capacity hasn't shrunk meaningfully this year. But as you go forward, all the other players in the frac space, that the greatest investment rate is to maintain your existing fleet. What we're doing, build new gas generating capacity and basically maintain the size of a fleet. Only probably one other of our competitors is investing at that level. The others are investing, but not at a level to even keep their fleet capacity flat. So I think we're going to continue to see available frac horsepower in the next few years decline a little bit, maybe flattish demand. So Rystad's projection, maybe a little bit firmer marketplace in the coming years. That's a crystal ball, who knows? Electricity, I'll be briefer on. Everybody's heard 1,000,000 times over that electricity demand, after growing about 0.5%, little more than 0.5% over the last 20 years, is projected to grow faster going forward. Who knew more energy we could do more things? And so wow. So, but we've made our grid more fragile, even with a roughly flat demand. So we're seeing, if you want to buy power in the forward market, it's becoming much more expensive. And that's why when we went to this natural gas burning equipment, the default example is build an electric frac fleet and bring out a gas turbine or hire another company to provide electricity to your frac fleet. At Liberty, that's just not the way we roll. So we develop both electric frac fleets, but also the generating capacity to generate that electricity itself. And when you go down to smaller scale and intermittent loads, turbine's the wrong answer. Reciprocating engine is the right answer. So Liberty has developed a gas reciprocating engines with very high thermal efficiency to generate electricity to power our electric frac fleets. We drive up on location and build a 25 megawatt power plant in under 48 hours. We operate it for a month, up and down, max power, off power, whatever. We run it for a month. We tear down that power plant, drive it over somewhere else, and stand it up. So as you see a grid becoming more fragile and people struggling to get firm power and power prices escalating, there's probably going to be an application for that ability to deliver high thermal efficiency natural gas generated electricity at anywhere you want it. So we've generated more cash than we've needed to grow our business. I think a key thing for a business, you got to own your own destiny. So what have we done with that money? These are cumulative, these bars on the right, but that's about $600 million in the last 2.5 years of excess cash we've generated. The biggest use of it, buy our own stock back. You know, we traded 8 times price to earnings with a significantly higher return on capital employed than the S&P 500 that traded at 20 times price to earnings. Like, that's not rocket science. We're buying our stock back and shrinking it. We pay a quarterly dividend. We raised that 40% last fall. We'll address our dividend policy every fall. And then we buy unique companies or assets. That's that gray bar in between. I mentioned PropX, a handling of PropX, a company we founded years ago. We spun it out. We bought that company back in. We'll buy technologies and invest in those things. And we'll invest a little bit in adjacent energy companies, which I'll talk about in the next slide. But so Liberty generates cash, reinvests it wisely, and then continues to shrink our share count. We more than doubled the size of our business by issuing about 67 million shares of our stock to Schlumberger. They've sold out of those completely, and we're coming up on buying 40% of those shares back. In another 2 or 3 years, we'll have a lower share count than when we went public. We have done a little bit of investing in adjacent businesses. Fervo, next generation geothermal. This is an idea I worked on 30 years ago. This is mining the heat from underground to produce electricity at the surface, but using shale technology. There's very few places where there's really hot rock and with fractured conductivity in the rock, and it's all full of water. That's today's geothermal business. Next generation geothermal is anywhere right under our feet. 2 miles down, the rock is hot. Drill shale wells, inject fluid through shale networks, flow it through that rock, mine the heat, produce it out the other well, produce electricity at the surface. Is it as cheap as combined cycle power natural gas? No. Will it continue to get better? Yes. And can we do it today at an economic return for contracts we can sign today to sell firm electricity, for example, into California? Yes. I'm very excited about Fervo. The biggest scalable energy source besides hydrocarbon that provides energy of value, meaning that it's reliable and firm and it works whether it's dark out or light out or the wind's blowing or not. Energy you can run your lives on is nuclear. We get reached out to by people across the energy space. I did a survey of all the small modular reactor companies. Oklo to us, this is a couple years ago, runaway winner on that. Right technology, which is fast neutron, metal cooled, and right business model. Don't go through the NRC and then go through another bureaucracy of a utility. Get through the NRC and then build and own the plant yourself and sell power purchase agreements. The interest and the demand for the power from these plants is just tremendous. Natron is a small next generation battery technology company. Sodium ion batteries, some significant advantages over lithium ion. Energy density is not one of them. So they're not all electric cars aren't going to run on sodium ion batteries. But if you need power in and out quickly, you want fast discharge rates, fast recharge rates, and you want to get rid of the thermal hazard, sodium ion batteries. There's a future for them. The last thing we've done is invested in the Beetaloo Basin in Australia. Just an awesome gas-in-place resource that's in Australia, the Northern Territories, the Midland of Australia. Just a gigantic amount of gas there. There's a challenge to figure out how to make these wells economical and reliable, but that's what the shale revolution was. It started here. We figured it out here. Can we figure it out in Australia? I suspect we can. I think the gas in place is just tremendous. And Southeast Australia, where everyone lives, is actually starting to see higher and higher gas prices. Australia is a huge gas exporter, but they produce it offshore to the north and the west. Other people live in the southeast. They need more gas. The idea of Tambour and the Beetaloo is first supply the Northern Territories, then supply Southeast Australia, and ultimately tap into the LNG markets. This is a of order Marcellus shale gas deposit. Ending, Liberty, we're sizable today, $4.5 billion in revenue, $1.1 billion in adjusted EBITDA. This is trailing 12 months, $2.50 a share in earnings per share. That's the Liberty story, and I'm sticking with it.